Good afternoon, ladies and gentlemen. Welcome to the SOURCEBIO International PLC final results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Please simply type in your questions at any time and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company review all questions submitted today and publish responses where it's appropriate to do so. Before we begin, we would like to submit the following poll that will be with you very shortly. And before I now would like to hand over to Tony Radcliffe, CFO, and Jay LeCue, Chairman from SOURCEBIO. Good afternoon.
Great. Thank you, Mark. And thanks to everyone for dialing in tonight to go over our results presentation. My name is Jay LeCue. I am the executive chair of SOURCEBIO. I joined in 2016. And from that time until now, we've been working very hard to increase the size and scope of the business. I've got a lot of experience with UK-listed life science companies, primarily in the pre-commercial years, and I do believe that SOURCEBIO has a great opportunity to significantly change the pathology business in the UK and also the precision medicine business that we're working on our genomics side. Tony, I'll hand it to you.
Yeah, thanks, Jay. So just by way of quick introduction, I'm sure I've spoken to a number of you before. Tony Radcliffe, CFO. So my background is I'm a UK chartered accountant, MBA, spent 20 plus years entirely in high growth technology businesses. I guess the emphasis very much on high growth, mixture of sectors, but actually a very large proportion of my time has been in life sciences and healthcare, and hopefully actually quite a good mix of operational experience, transactional experience, quite a lot of M&A, and actually quite a lot of M&A on the A market as well. So hopefully very relevant to what we're doing and what we're looking to do going forward. I've actually been with the company just over 2 years, and I'm obviously delighted to be here. So I am going to drive the slides, and I'm going to, I think we're going to actually lose our videos, if that's okay, going forward, just so the screen is bigger, but we'll pick up with you shortly.
All right, well, just a sort of an overall summary of the business. We're a leading provider of clinical and drug development lab services to the blue chip, pharma, NHS, and private hospitals. 2021 was an outstanding year of both financial and operational progress. The focus has switched from primarily a COVID operation to the acceleration and development of our core business units, which we will get into in more detail. And I just wanted to point out that we've got some very solid core businesses that were there before the IPO, and they were invested in. They're already coming back and growing very significantly moving forward. Significant revenue and earnings growth last year enabled organic investment and strategic M&A. We did finish our first deal, acquisition of LDPath, closed in March of 2002. It's a digital pathology business that very much augments and complements our cellular pathology offering. We're mostly a wet lab. They've got most of their revenues on the digital side, and we do believe we can change the way the UK does cellular pathology in a way that's happened in radiology and other aspects of digital technology. COVID-19 was an extremely successful hedge, and I want to make sure we're pointing this out. We were in the cellular pathology business. It was growing at 40% a year prior to COVID. We realized what was coming with the cessation of elective surgeries. We did hedge into COVID. We became much more successful and larger than we had imagined. And now we are taking the success of that and putting it back into the base business. And I think going forward, certainly there's still COVID testing going on. Many hospitals want to make sure someone doesn't have COVID going into an ICU or some type of surgery suite. But it's certainly not going to be at the level it was in the middle of the pandemic, and we're not considering it a core opportunity going forward. But we will support the need for testing as needed going forward.
Okay, just some financial highlights. Obviously, you've seen the RNS and you've seen these sort of key highlights. I'm not going to go in through each one, but obviously a very strong set of results. Revenue has grown 82% up to 92 million in the year. Obviously, gross margin as well similarly increased. Essentially maintained a similar sort of 39-40% gross margin. And that's fed its way all the way through down to EBITDA, earnings per share, and so on. And I think what we shouldn't lose sight of, to Jay's point really, whilst the numbers have been absolutely dominated by high volume PCR sales, I think we shouldn't lose sight of the fact that actually for us, the important aspect of this going forward is that the core business actually grew 18% year on year. And in particular, actually, cell pathology, which we're going to spend a lot more time talking about, grew 78% year on year. So that's very sort of helpful metrics. I think as we go, beyond the P&L into the cash in the balance sheet, obviously we generated very substantial cash flow and cash conversion from the operations. Grew that to 33.2 million of cash generated. We ended the year with closing cash of 33.3, up very significantly from the 8.4 at the end of 2020. And again, very importantly, the COVID for us has been absolutely about building the strength of the balance sheet and then putting that cash, those resources to work to build the ongoing base business units, both organically and through M&A. And obviously, we're going to demonstrate how we've put, a part of that cash generated to work with the LDPath acquisition, but clearly we retain a strong balance sheet even after that. And I think the other point I'm going to mention here is that, we've clearly executed a very strong year in terms of building volume on PCR side, both through 2020 and then in fact doubling things up in 2021. And obviously, going through the whole cycle of billing and collecting and turning that into cash conversion. And I think, to be honest, that's the same set of skills that are hopefully going to serve us very well as we actually will see a similar huge opportunity in cell pathology in 2022. So, hopefully that's where the team will put their skills to work going forward in this year. But more of that to come. Okay, so here's a little bit of a graphic. Again, this is buried within the RNS, so you've seen this detail, but really just highlighting the growth in terms of the three core business units: healthcare diagnostics, genomics, and stability storage. So as you can see, healthcare diagnostics, fastest growing business unit in overall terms, 45% growth. And I think, as I mentioned earlier, buried within that is the cell pathology piece, which actually grew 78%. And importantly, actually, the second half was twice the size of the first half. Genomics, strong growth here, 18% growth. And finally, stability storage. We'll come back to some analysis of the 2% growth. So there is growth in the key high profit and recurring revenue piece of storage. There's a little bit softer on the equipment or capital sales piece. So I think we can explain that. But in overall terms, strong underlying growth from the base business, 19%, and clearly in absolute number terms, you can see the growth in infectious disease testing, very material.
All right, thanks, Tony. We do want to touch on the stability storage business being up 2%. It's actually the impact of equipment sales, as Tony mentioned. The stability storage business itself, that is stored product, is up much better than that, and that's the real profitability of the business. We can talk about that in more detail. I just want to make sure that we highlight that. So this is a snapshot that if you've seen us present before, you might have seen this graphic on the right. We really wanted to highlight basically the tissue sample aspect of the current wet digital pathology process. So you've got NHS, private hospitals that will either send us tissue samples or they will send us pre-prepared slides that we will then process, send to our pathologists. They take a look at them. They take the slides, send them back to us. We write the report. We then send the slides back to our client. It's a bit labor intensive. It's very manual. Digital will take out all of the courier of slides and effectively enable us to digitize images either in the hospital or in Nottingham, which will make things a lot faster from a turnaround perspective. And right now, LDPath has a turnaround time of no less than 24 hours. We think we could improve upon that, but certainly from our perspective, we're looking at 5 to 7 days going to 24 hours. That's a significant improvement for our clients and their patients. I did say this earlier that pre-COVID source cellular pathology, the source business was growing at 40% per year. Certainly post-COVID, we're seeing an increased pace of growth with the sort of bolus of elective surgery cases that are coming back online. Combined, Source LDPath is now the leading pathology service provider in the UK. We've also got the largest consultant pathologist network in the UK. They've got about 120 pathologists. We've got about 120. Combined, there isn't much overlap, so we've got a very strong pathologist network. Our digital pathology system is UCAS accredited and validated, and I will say that digital pathology represents 25% of the combined source LDPath revenues, and growing, I think, from LDPath's perspective, is something like 70%. So it's a great addition to what we're offering. The market is absolutely going digital, and we are at the forefront of that. And we, again, I've repeated this before, we really do see this as a sort of a revolution in the way people are doing pathology in the UK and beyond.
Okay, thanks, Jay. So just to give a little bit of financial context to the healthcare diagnostics business unit, you can see here the two components: cellular pathology, which I mentioned has grown 78% in the year. The second component here is actually reference laboratory. I'm going to ask you to park this. So this, from 1st of January, actually will be shown within the Genomics business unit, but for 2020 and 2021 is being shown in healthcare. But obviously, clearly, strong growth in the year. And maybe what I'd like to do is point your eye to the chart here on the bottom right-hand side. Apologies, it's got no sort of axis, vertical axis on the left-hand side. But what this is showing is monthly revenues, actually through 2020, through 2021, and actually the first quarter of 2022 as well. And obviously, revenues is an analogous really to the volume and throughput. And what you're seeing here is essentially very strong pickup in recent months. I mean, through 2021, I think it's fair to say that the second quarter of 2021, for example, was nearly 80% above the first quarter of 2021. Q3 over Q2 grew essentially an extra 60%. Q4, as you can see here, is relatively flat, and that was obviously while Omicron was taking some hold, so that kind of paused things. But then we'd always talked in the past about this sort of tsunami of additional work coming through as the elective surgeries returned and this huge backlog gets addressed. And I think it's fair to say this graph clearly demonstrates that we can see that coming in with full force. So the steepness of the gradient here, I think, is our real challenge and our real opportunity. And admittedly, so this does go up to the end of March. So there are 3 weeks of the new LDPath acquisition within just the last few millimeters of this graph. But fundamentally, the gradient is exceptionally steep, and I think that's our challenge. So whilst we have a lot of work on integration, we've done a lot of pre-thinking, etc., attached to that. The biggest exam question really is about scaling up capacity and securing as much of that business as we can see out there as is humanly possible, and that is our challenge. So at the start of the presentation, I mentioned how we'd executed a huge scale up process through PCR, and I think that's where we see ourselves replicating that same process through the cell pathology this year. I think on gross margin, might just say a second on gross margin. Clearly, you've seen here a growth of 24% to 33%. I think importantly, the cell pathology piece, it was pretty low in 2020. It was about 17%, and that's grown to 35%. And I think that's clearly based on the volumes picking up and returning. But I think the point here is that pre-COVID, cell pathology was at 40% gross margin, and in our mind, that's an absolute minimum. But what we should see going forward is, particularly actually as we get more volume, more scale, get a more digital component within that, and obviously the benefit of some private healthcare work as well through LDPath, we should see that gross margin tracking up. So I think, again, plenty of upside both on volumes and margin.
So this is the way we're looking at the outsourced pathology market in the UK specifically. So the number one growth driver is the shortage of UK pathologists, and that was happening well before COVID. It's the reason we were growing at 40% a year pre-COVID, and that's continuing on into today. Now you've got the delay in elective surgeries, which is increasing this backlog that we talked about, and Tony was talking about this tsunami of work that's coming. That's coming. And on top of that, now you have future growth from the market that was growing at 40% a year, but it's a bigger pool and it's still growing. And there's still a shortage of pathologists. And now what you've got on top of that is a structural shift to digital pathology, which means reduced diagnosis times, higher capacity at lower costs. And that is why the market will move to digital, because there is such a backlog. The efficiencies of using digital cannot be argued. We're going to work very closely with the NHS and private hospitals to implement digital as quickly as we can. And I will give LDPath credit. They have done a great job of developing a plug and play, so to speak, digital pathology platform that's open system, can work with any scanner in the market and get up and running and validated in a very short time. And they've done that. As I said, 70% of their revenues were from digital. And so we really see this sort of market opportunity continuing to expand. This is just the headline of the deal, 18.5 cash. You can see the positives of SOURCEBIO and LDPath. I just think this is that if we could have picked an acquisition from our pipeline other than this, I don't know what it would have been. This hit every checkbox we wanted to accomplish. We had been saying we're going to focus on cellular pathology. We had been saying we want to focus on new technologies. We found a company that is from not very long ago created a world-class business that is enabling hospitals to move to a digital platform. And this is just something that we think adding to Source and the scale that we have with our wet lab capability is creating a leading cellular and digital pathology offering. Acquisition rationale. I've covered many of these, but I'll go through it if we've missed any. Certainly strengthens our position as a leading outsourced provider. I did mention 70% of LDPath business is from digital. That's incredible. There isn't much digital going on, and I will say LDPath has done an excellent job of generating clients on both the NHS side and the private hospital side. They have been particularly effective in London in the private hospital network, which we were not capable of doing ourselves out of Nottingham. So that's another additive customer base to us that'll help us not only in pathology, but also precision medicine, which I'll talk about in a minute. We've talked about the opportunities, the shortages, the backlog, the migration to digital. The plan is to accelerate conversion to digital with our existing customers. And one thing I wanted to point out with digital is you've got an artificial intelligence capability that will enable physicians to become much more productive, because if you've got an artificial intelligence program that can screen out very obvious cancer cases or very obviously not cancer cases, the pathologist still signs off on those, but he doesn't need to take the time to look at those because we've got data that suggests artificial intelligence is better than the human eye. And if you look at radiology as an example, right now, if you take a digital image of a brain and there's a brain bleed, the digitized image will be able to pick up a very small brain bleed that a human eye would not be able to pick up. So we're going to see the same types of advances in diagnosis with digital pathology, and that's why we believe it's just going to be absolutely unacceptable to not move into a digital platform. We do want to expand internationally. We could get into the Middle East, get into Dubai, get into India, get into Australia, and create sort of a sun never sets capability. I will say LDPath had started that. They didn't have the scale to do that. Now that we're partnering up with them, I think we will be able to do that and really create a business that is not just based in the UK, but not just UK, much more international in focus. And one thing that I didn't point out before on this prior slide was this was an immediately earnings enhancing, and it's going to be a great addition to our business, as I've said. This is just what we're presenting to customers. I wanted to just share this with everyone. We did take the name and call us Source LDPath. They've got a very good brand name. They've done a lot to move the market into a digital space. We've obviously got a very strong brand name. The combination of the two has been extremely well received from our customer base, our client base. We announced the deal a week before one of the largest congresses in London on the pathology side, and it was very well received by everybody there. So the combination of the two businesses really does create something unique in the UK, and we're looking forward to expanding this business. Genomics business, 5 million revenues. It's a smallish business at this point. I will say, we consider genomics to be, work on clinical research and drug discovery. Outsourcing is preferred. Most pharmaceutical companies don't want their staff doing basic sequencing. We have two types of sequencing, Sanger sequencing and older technology, which is the sort of quality standard, the gold standard for sequencing for drug development. Next generation sequencing is whole genome sequencing, much more massively parallel. We are investing in a new facility in Cambridge, expanding it and doing more types of services. For example, extraction services that we are repurposing the kit from the COVID business into a new offering in Cambridge. We've talked about this investment in NovaSeq and larger projects. That is happening. Commercial team, very experienced people. And one thing that I did mention before, this precision medicine business unit, it's a combination of a ref lab from Nottingham and some clinical research done in Cambridge, and we're really pulling it out and making it a separate P&L internally. This is a market. I'll give you an example of a precision medicine assay, EndoPredict, which is a Myriad assay. We've got the rights in the UK to a Myriad assay, and it basically takes a tissue sample from a breast cancer patient, put it through the system, and you can determine which chemotherapy treatment would be best for this particular patient. So it's down to the genome level, it's down to the individual patient level, and that's the type of medicine, and that's the type of services we want to be offering in the future. And it's where the market's going. I wouldn't say we're ahead of the curve, but we're on the leading edge of the curve to develop this business. And I think this, in combination with what we've got in Cambridge with the NGS and the Sanger sequencing, means genomics really from I guess a business perspective has a lot of headroom for growth, and we're investing very much organically in this business, and we will continue to do so.
Okay, again, just a short slide really on the financials of the genomics business. Again, you can see the two components that Jay referred to, Sanger sequencing and NGS, and a total, and obviously on a combined basis, 18% revenue growth. So I think that's where we expect this to be. Absolutely. I mean, what's probably evident here is the shift in mix, and again, you can see the bar chart on the bottom right-hand side. So very much a strategic decision was made back in 2019 to actually move away from perhaps the lower value, more commodity Sanger type sequencing to the next generation projects. In other words, larger, more complex, and potentially more profitable projects under the NGS skies. And I think to be quite honest, whilst we're absolutely migrating in that direction, there's a little bit of work to be done on the pricing and the margin. So you are seeing a little bit of margin slippage here, 41 down to 39. Sanger's performing pretty steadily at 50%, as you'd expect. But I think there's some upside on NGS, and again, we're very focused on addressing the pricing. Certainly, we've seen some internal wage inflation. I think every other business has too. So that's very topical right now. We're addressing pricing. We certainly need to be selective about some of the projects we take on in NGS. So again, see potentially decent amount of upside as we actually pull that margin up in NGS, which is where it needs to go.
All right, let's talk about stability storage. Very solid business unit. But stability storage is effectively storing drug compounds, finished product, stents, medical devices in controlled environmental chambers to mimic conditions throughout the world. And it's used for drug filings and keeping drugs on the market to make sure they remain stable. So it's a high value business. And the services side, where we're actually renting out our storage space to customers who bring in their samples, it's well over 50% of this business, very high margin, 80% recurring revenue business. So contracts are generally 3 to 5 years. They come in and take samples every quarter or every month, depending on the SOP. Very high margin business, just sort of a nice annuity stream, so to speak. We do manufacture and sell storage equipment as well. I will say that has been a particularly lumpy business. That's why the growth is not where we expect it to be. We are looking at options to expand our capabilities and perhaps look at other ways to improve the manufacturing side of this business. I'll just leave it at that at this point, but we are certainly looking at a way to make that more profitable and that less lumpy, and that sort of less of a fixed cost and maybe more of a variable cost. And then service and validation, which is the second biggest part of this business, is very profitable, 50-60% gross margin. That we also expect to be able to expand and perhaps do more service and validation of more equipment other than ours as we expand our validation portfolio. So that's another area of growth we're looking at in this business. Storage growth is driven by capacity. We've invested in Ireland. We did invest in the U.S. pre-lockdown, and I believe I've mentioned that we did see a bit of a shortfall in the U.S. where we had a site in LA, we moved it to San Diego, and during the pandemic, people could not come to our facility to audit our new facility. So we are getting that business back, and we are seeing the business in the U.S. recover. I talked about the long-term commitments, typically 3 to 5 years. And then certainly equipment sales drive the need for service and validation, but we think we can go beyond that and service other people's equipment and do more validation work for our customer base. So it's a very solid performing business, and the storage side of the business is a very nice high margin revenue stream. So I just wanted to highlight that as a business unit.
Okay, thanks, Jay. In fact, I think you've probably mentioned most of the dynamics around the various revenue streams. Obviously, storage, service validation, and manufacturing. And I think Jay elaborated to some of the dynamics here. So, clearly storage up 7%, which is good. I mean, there are some underlying reasons. We'd like to see that a little bit higher. But at the end of the day, this is, for us, is absolutely about visibility of earnings. So this is a little bit like a SaaS software model rather than an upfront model, where we're adding incremental pieces of revenue on a basically recurring revenue on highly visible, long-term, sticky contracts. And as Jay mentioned, in fact, the gross margin is more than 80%. It's between 81 and 82% gross margin. So, it's a very nice, robust business to have, and obviously been pretty robust through COVID. Service and validation, not quite flat, but I think there is a reason here, and that's the ongoing travel restrictions have by definition meant that folks haven't been able to get onto client sites quite as much as would be hoped. But again, that would put down to COVID. And I think manufacturing, I think we've flagged that's certainly an area that we're looking at, and this low level of volume, it's immaterial in the round, but it's clearly something that we need to address going forward. Okay, one slide really on COVID. Whilst the numbers certainly in absolute terms, the biggest of the business units, I think we're honest. We recognise that we've been through a huge peak of activity. We've scaled up operations in terms of PCR volumes. Back in 2020, we did something like 750,000 tests. We got up to a peak of about 10,000 a day. Back in 2021, essentially, again, absolutely about pushing scale. We did something like 2.1 million tests in the year, and hit a peak of about 20,000 tests in a day. So, what we're seeing in 2022, clearly this isn't core strategic going forward to us, but we do see a modest opportunity. Volumes are now something like 1,000 a day, give or take, and that's fine. So we've obviously right-sized the team and the cost base, etc., to match all of that. We've got some inventory that we're keen to burn, and whilst there is a market appetite, that's fine. We've obviously got to it's got to wash its face here, which it is doing. But I think the point here is, whilst we're coming down the other side, clearly we have put CapEx investment into this business. We have expanded laboratory space, kitted out laboratory space, and we've hired people. And so our job really is to manage the orderly scale down, if you like. And what we're doing is essentially, it's perfect timing in a way. And again, it comes back to this natural hedge. But whilst PCR testing, has been and is declining, we're essentially repurposing laboratory space to cellular pathology. So obviously you heard about our challenges of maximizing throughput and huge demand for cell pathology work, while we have the lab space in Nottingham to repurpose, which is helpful. Some of the PCR equipment is actually being repurposed, being sent to Cambridge for use in the genomics business. And clearly, as far as we can, we're keen to redeploy internal staff to the faster growing areas of the business. So I think we're handling this relatively well, and but again, not core to the numbers going forward, but we still see enough opportunity that we should press on. Okay, so in terms of the income statement, well, again, I'm not going to grind through all the numbers here, but you've seen a strong set of results. Revenue growth up 82% and maintained the gross margin. Clearly we've increased our cost base through 2021 as the business has expanded, and we're addressing some of those areas just to kind of right size some of that. But obviously strong bottom line performance, strong growth in earnings per share. And that's a summary of the P&L.
So 2021 highlights. I'm just going to cover this first bit. I think Tony did the second bit below, but execution on strategy, strong operational financial performance. I have to take my hat off to the entire company, number one, for weathering the COVID storm, but in particular the group in Nottingham who had worked weekends 24/7. I mean, this group worked exceptionally hard to meet the challenge of the COVID testing needs during the pandemic, and it was just great to see the business perform as well as it did. We certainly maximized profit and cash during the COVID situation. We are now directing our resources to cellular pathology and genomics. The growth strategy and focus is both on organic and an M&A pipeline, which we continue to have. We did close LDPath in March. And I think, again, as I mentioned earlier, our focus had been on building the cellular pathology business, and the LDPath acquisition was just a very, very solid fit with what we're trying to do with the business moving forward. And then the financials speak for themselves, and I know Tony just went over those. So summary and outlook, 21 was a very, very good year for us. PCR generated earnings enabling investment, solid growth in 3 core business units. The focus is on accelerating the growth of the core businesses, as we discussed. Certainly, COVID is going to decline. There's still a nascent COVID business there, but it's not something that we're going to consider a core part of our offering going forward. Unprecedented market opportunity for outsourced cellular pathology. I can't stress that enough. We really do think we are on a sort of once in a lifetime change in the way people do pathology. Completed the LDPath acquisition. The integration is going great. The senior management team is all staying. We've just created a really good combination of 2 businesses, and we're taking the best of the best from both and creating an even stronger business than either one could have been on their own. Encouraging growth opportunities in genomics, and I did talk about precision medicine. I don't want to oversell it. It's a smaller part of our business, but I do think that's a huge potential if we execute on it properly. Strong balance sheet. Capable of supporting significant future growth, both organic and via acquisition. And trading in the early months of 22 has been strong. I'll say that more than solid.
That's great.
So that's what we've got. We'd like to open it up for questions.
That's brilliant, Jay. Let me just jump in and just give you a few moments to have a look. So, ladies and gentlemen, please do continue to submit your questions using the Q&A tab, just situated on the right-hand corner of your screen. Just while Tony and Jay take a few moments to review those questions submitted already, I'd like to remind you that a recording of this presentation, along with a copy of the Q&A and the slides, will be available via your Investor Meet Company dashboard. Jay, Tony, I've given you no time at all, probably added very little there, but hopefully that's given you a few moments to open up the Q&A tab. I will shortly bring up your cameras as well, but if I could ask you to read out the questions and give a response where it's appropriate to do so, and then I'll pick up from you at the end.
Right. So I'm trying to let me get. There's quite a few questions here. We'll try to get to these. Well, I actually want to. This first question is a great one. Great acquisition, LDPath. Could we advise why we paid cash rather than cash and equity? To be completely frank, there isn't a lot of equity out there. Liquidity is a bit constrained, and we really wanted to just make this a clean acquisition. There's certainly an earn-out capability, and the management team is absolutely committed to growing the business. Alistair Robson, the founder, really is committed to making this business a success. He even made the comment that he wants to birth this baby as part of our integration and ongoing business. So I think we've got a very dedicated team. So I know generally giving equity is an incentive for the management team to stick around. I can tell you they want to stick around. They want to build this business. And for us, it was easier to pay cash than worry about getting additional shares out from a market that is pretty tight. What are our views on dividends and share buybacks? We did say we're going to put together a share buyback program. It'll be as part of our AGM. We think the stock is extremely undervalued. Certainly dividends, I'm not saying no, we're not taking it off the table, but if there is another target or an acquisition that can grow the business more effectively than paying a dividend, I think we would probably prefer to do that over a dividend, although you never say no to a dividend. So that's how I view that. There's one about digital tissue samples to avoid career. Well, it's actually a scanning technology that you take the tissue sample and put it into a scanner, and it creates a digitized image, is basically how you do it. And then what are our revenue expectations for 22? I don't think we want to give a forecast. I mean, Tony, you can handle that one.
Yeah, I'm happy to take the question. That's right. I think it's difficult to put a forecast out there, but I think what I'd probably point to you is the kind of growth levels that we're seeing in the various base business units. I think Jay might have mentioned that even pre-COVID, frankly, the cell pathology business was growing 40% a year. You've seen the trajectory in recent months, so we're obviously very upbeat about that. Genomics, I think we mentioned, was 18% in 2021. So again, you can sort of extrapolate that as you wish. Stability, I think, yes, we had a bit of a blip on the manufacturing side, but I think if you strip that out, this is more about quality of earnings rather than absolute racy growth percentages. But again, that should be high single digit or low teens. So again, I'll let you extrapolate that. And I think finally, in terms of a non-core business unit, we think we've got, this year certainly of PCR, and I think I indicated that we're certainly starting the year at something like 1,000 tests a day, and we do honestly expect that to sort of trickle down. I guess it might be a bit lumpy along the way, but in principle, that's where we are. So again, I'll perhaps let you guys do the maths, if that's okay.
Okay, thanks, Tony. Next one, when do you expect integration of LDPath to be complete? I mean, the integration is going very well. I think some of the basics of integration will be completed, within the next quarter. I do want to highlight that we are creating almost a new business out of this acquisition and combining the best of the best. So in some ways, the acquisition will never be complete because we want to continue to build on each other's successes and build on each other's strength, and that's where we're going as a business. So, I mean, the basics will be done, 6 months, in my opinion, but we certainly want to continue to leverage the skills of both sides and continue to grow the business. Would you consider acquisitions to grow genomics? Absolutely. In fact, I want to make sure I'm clear on that. Certainly, we are investing organically in genomics right now. But even in our pipeline, there are a few CROs that are in the personalized medicine space and precision medicine space that we would absolutely consider and are considering. We'd have to make sure that it's something that we believe we can plug in and grow the business. So yeah, we are interested in acquiring businesses that can help grow our base business. It isn't just related to CellPath. However, there is a CellPath operation that we looked at that has offices in the United States and around the world that could be a nice additional business to add to our CellPath business. So we're being very optimistic and cautiously optimistic about what we're looking at from a pipeline, but we've got a very nice pipeline of opportunities moving forward, and we'll see how that goes. Well, main competitors in the UK, obviously Unilabs is a big one, HCA is a big one. On the digital side, Leica Biosystems sells systems. I don't think they actually compete with us on the services side. So we're not selling, we're not selling equipment. We're selling the service of what the equipment does. So competitively, it's really more of the service providers, like I mentioned, Unilabs, HCA, which is backlogs actually. Here's one that says, "What you need to do." It's a question about would we do an acquisition outside the UK? Yes, we could. We don't know if we necessarily have to. UK is a very solid growing market for us. Certainly, we're looking at international opportunities, as I mentioned before. And hang on, there's something about. Yeah, Tony, you want to take this? 33 million is after, it's before, but you can take that.
Okay, so the question is the 33 million of year-end cash after paying for LDPath? So to be clear, we ended the year December with 33 million of cash and no debt. We acquired LDPath actually in I think the first week of March 2022. So clearly the initial consideration has come off that 33 million. But importantly, I think we announced on the day we still have cash of 16 million at that moment. And for us, that's absolutely supporting a strong balance sheet, which will grow the business organically. And as Jay's mentioned, potentially additional acquisitions.
Yeah. Here's one. How are you managing increased input costs, and what's your ability to pass on extra costs? I'm very glad to have this question. In fact, I meant to touch on this during the presentation. We are in the process of putting through a 10 to 15% increase in prices across the board in the business. We need to do it now. This is when the costs are increasing. Everyone's used to the inflation that's happening, and we definitely are going to pass. Look, we're not going to gouge it, but we're going to make sure we cover our costs. We have had wage inflation. We have had supply inflation. We do have energy inflation, especially if you consider the amount of energy it takes to keep storage chambers running. So we are definitely moving ahead with price increases to across the board. There's another one from on the LDPath acquisition was done at a very high multiple. I would disagree. I think the multiple is probably about 13. And is there a growth projection of the business? Yes, there is. We're very careful about sharing that because I think we wanted to be careful at the time of the acquisition. Do you want to show that that comparative slide, Tony, on the...
Yeah, I mean, just to add to that, so I don't know if these slides get distributed afterwards, but there is a comparative sort of deal multiple slide buried in the appendix. So this, if it does get distributed, then we're happy for you to see that data. But to Jay's point, I mean, we think actually, I mean, historically, when you compare, that's the slide, thank you. I mean, if you look sort of way back to, 20 and early 2021, the metrics, just like us, LDPath did suffer through COVID, but they've seen the same sort of growth trajectory in recent months as we have. So I think the point is we're looking forward, and we think we paid actually on a good multiple. And, whilst there are a number of plans, available, I think, even on a relatively modest plan, we can see them, potentially to multiple of less than 10 in year 2. So, I mean, that's the way we look at the business. So we're not having to stretch things too far to get to a sensible multiple at all, I think is very definitely our view. And I think the other point is we know for a fact that they've been courted by at least 2 other parties within the last 9 months. And one of them actually at a very significantly higher consideration level. So we think we've got a good deal, and the reason they liked us was for the perfect fit, frankly, and that's, that was key.
Yeah, thanks, Tony. A house broker change forecast, Tony, you can take that.
No, it hasn't. So we spoke to Liberum back in March. Yeah, so we've updated along the way, particularly on the COVID side. But in terms of the base business, no, absolutely, the forecasts are the same, and obviously they're baked in to include LDPath.
Okay, revenue and earnings, LDPath. I mean, we don't share that, but Tony, why don't you comment on this one from?
Well, no, that's right. I mean, I think what we can say is historically, I mean, I think we shared our data on cell pathology, that we were just under sort of 5 million of revenue last year, and obviously, but very, very fast growing. And I think it's fair to say that LDPath is a similar order of magnitude. So they've actually got a January year end, but essentially produced a very similar level of revenue, actually with a similar size of team, although it is worth saying they're arguably more profitable because their revenue is focused more to private healthcare providers rather than the NHS, and frankly the pricing there is higher, so they're generating those earnings on lower volumes, but they are experiencing a similar growth curve going forward.
That's great, Tony, Jay. I think you've taken every question from investors. So thank you so much for your time. And thank you to those investors that have submitted those questions. If any more do come through, we'll make those available to you, Tony and Jay, after today's meeting. Just touching on the point, you will receive an email from us when the transcription has been completed, and you will be able to get the slides that have been presented to you this afternoon and be able to download them at your leisure. Jay, I know investor feedback is important to you and obviously to you, Tony, and the company, and I'll shortly redirect investors to provide you with their thoughts and expectations. But before doing so, if I may, Jay, just ask you for a few closing comments, and then I'll ask investors to give you their feedback.
Great. Thank you, Mark. Look, I want to thank everybody for dialing in today. I hope we've done a good job explaining what we're trying to accomplish with SOURCEBIO. The questions were very good. Thank you for asking those. If there are any more, please send them in. But we really do believe we've got a platform for growth. And one thing that I've been saying to all the institutions we've been meeting with this week is that, I think initially when we took the company public, we were viewed as primarily a COVID stock. We need to keep in mind that SOURCEBIO was a very successful life science business with a rapidly growing cellular pathology business prior to COVID. We are returning back to those roots, and we are executing on the strategy to grow all of our core business units. And that's what we want to look at going forward.
That's great. Jay, Tony, thank you once again for updating investors this afternoon. Can I please ask investors not to close this session, as we'll now automatically redirect you for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure it will be greatly valued by the company. On behalf of the management team of SOURCEBIO International PLC, we'd like to thank you for attending today's presentation. That concludes today's session, so good afternoon to you all.